You probably remember the CERB or the CRB or even the business wage subsidies that went into place during the pandemic. Now, these programs helped a lot of people, yes, but the cost of doing so may have been more harmful than if nothing was done at all. And now, just as of today, the Canadian government has let leak its plan to bring back pandemic-style benefits, potentially bringing back $2,000 payments for citizens, but also costing billions of dollars. And this is all as a response to the potential tariffs coming from the U.S., tariffs that have most recently been estimated to be coming into effect as early as February 1st. This is big. Now, obviously, there are some major concerns that we need to talk about, but first let's talk about what these benefits are and how it could help and hurt Canadians in the sneaky way that I think the Bank of Canada could have already been preparing to get involved with this, with the risk falling to the average Canadian. And also at the end, we'll talk about how this could end up delaying any elections that we could be expecting. So let's get right into it. Here's the headline from Globe and Mail: Ottawa planning pandemic-level relief for workers and businesses if Trump imposes tariffs. And in the first line here, they say that the federal government is planning a multi-billion-dollar pandemic-style bailout for workers and businesses if these tariffs are to go through. Now, of course, this is breaking. We don't have all of the details yet, and we don't know a lot about these benefits, but if they are to come into place, it's likely that they'd be income tested, meaning you have to make below a certain income threshold in order to qualify for them. If they truly are pandemic style, it could look like $2,000 per month for laid off people like the CERB and the CRB, the programs that were the pandemic sort of stimulus for the economy. You may even need to provide some sort of proof that you were laid off due to the tariffs. For CERB, it was a little bit different because they focused on getting this legislation and these benefits out the door as quickly as possible to help people. So as a result, they made it so people could just claim the benefit without verifying that they were qualified for it, which led to a number of problems down the road with the CRA clawing back this money from a lot of ineligible, at least in their eyes, ineligible people down the road. Now, the exact numbers aren't out yet, but all reports are pointing to this being a multi-billion-dollar program, which, of course, the government needs to pay for by taking on debt. Now, when we compare this to the COVID response, well, that was an $82 billion package. My guess is that this one is going to be significantly smaller in size, but it could be similar. Nobody knows for sure at this point. This is just leaked today. And sure, these kinds of benefits could help people and could help businesses, but it also could have some serious side effects that could affect you personally, not to mention for the entire Canadian economy. And there are elements of this that aren't going to be obvious to a lot of people, and elements that even the Globe and Mail hasn't included in its report. So let's talk about two sides of the same coin, then put them together so that you can understand exactly how this could impact you. It might sound complex, but trust me, it's way simpler than you might think. As I said, in order to implement a multi-billion-dollar project like this, well, the government needs to fund that. And despite what a lot of people believe, the government doesn't actually have enough money to operate and to do all of the things that it wants to do, just from the tax revenue and other revenues that it collects. No, on a regular basis, the government goes into debt. Now, people say, goes into debt to who? Well, this is how. It's very, very simple. Basically, the government of Canada, when they need to raise money for whatever reason, they'll sell a bunch of IOUs to the market. These IOUs are actually called Government of Canada bonds. These bonds are then sold to other financial institutions as well as just any average investor. Now, these investors would want to buy this debt or these IOUs from the Government of Canada because they say, well, market, if you give me $100, me being the Government of Canada, well, I will at the end of a year or 2 years or 3 years, I'll give you this $100 back plus interest. So it ends up being a pretty sweet deal for the people who buy these bonds or buy these IOUs or the government debt. But this is where things get really interesting because on these bonds, the interest rate that they pay, well, that can change depending on how much people want to buy these bonds. If people don't have a lot of demand for government bonds, well, then as a result, the interest rates that they offer or the return that you can get from buying these things, well, that interest rate will go up. Now, if there's a ton of demand in the market for these bonds, well, they don't have to offer as high of an interest rate in order to get people to purchase it, so they don't. They offer a lower lower return. Now, the supply and demand here has a big impact on what these rates are. And the supply side is entirely controlled by the government of Canada. If they need to, like for this project, take on a whole bunch of new debt, well, they need to add a whole bunch of new IOUs to the market, a whole bunch of new bonds. So by adding so many new bonds, that increases the supply without increasing the demand, meaning that they have to offer higher interest rates to get the buyers to actually see the value in buying this debt. And interestingly enough, the interest rates that are included on these bonds, well, those actually have a big impact on the interest rates that people pay in the economy, whether it be for a business loan that people are taking on, a car loan, even a credit card loan, but very heavily in Canada, the mortgage rates that people are paying. The interest rates that we experience in the economy are a large part impacted by the rates on these bonds. And if I've lost you at any point, we're going to get back to how this impacts you directly, but I have a couple more points to make here. Now, all of this is a big issue for the Bank of Canada, because if the government of Canada says we need to provide billions of dollars of stimulus to the economy and we need to take on debt to do it, well, that's going to create a lot more of these IOUs and it's going to push interest rates up. Now, the Bank of Canada right now has actively been trying to lower interest rates because they see, hey, the economy is not working so well right now. Businesses aren't growing. Sure, inflation is down a little bit, but the unemployment numbers are up. We need to bring down rates so that we can stimulate the economy a little bit more. So if the government of Canada adds all of this debt, well, they're going to have a harder time keeping interest rates down. And that leads us to the Bank of Canada's response to all of this, because if this plays out how we expect it to, they essentially have three options. First, they can keep their rates as they are and let the government of Canada's spending push rates up, which would, as a result, slow down the economy further. Well, that's option one. Option number two, they could lower rates even more at a faster pace to offset the effect of this further government spending. Sure, that's an option. But third, I think this is the most likely one, and the one that's most likely to have an impact on you. Their third option is to begin printing money again, like they did during the pandemic, and to use that newly created money to buy up and to absorb all of the newly supplied bonds, minimizing the impact of this new debt on the interest rates in the economy. Instead of having billions of dollars of new debt flood the market and increase interest rates, instead, the Bank of Canada can just slurp up these billions of dollars worth of bonds, and as a result, that's going to be added demand from the slurping from the Bank of Canada, meaning that the interest rates wouldn't be affected, at least not in the short term. And there are people currently lobbying to make this a reality. Listen to this. This is from the same article. Goldie Hyder, the president of the Business Council of Canada, said that even though Ottawa can't tell the Bank of Canada what to do, they hope that the central bank will be ready to provide more liquidity, in effect, to make more money available to lend or use if people or businesses need it, including the Bank of Canada. Mr. Hyder said he would also hope that regulatory rules covering banks could be adjusted to offer banks more flexibility to address the needs of customers, such as small businesses coping with an economic slowdown. To me, this last part sounds like lowering their capital reserve requirements, allowing them to make more and more risky loans. But I think that this would be incredibly problematic because if you've followed the channel over the years, you'll know we've thoroughly investigated the side effects of the monetary policy response to the pandemic, what the Bank of Canada did in response to sort of support the economy. And you'll know that some of these side effects may have been worse than if nothing was done in the first place. When this same sort of thing happened in 2020, after the newly created money funneled into the economy, we experienced incredible asset price inflation, increasing the value of the things that the wealthy elite tend to hold in this world. Things like stocks, precious metals, real estate, and hell, even crypto. Now, a number of months later, it migrated from just being asset price inflation, and it made its way to consumer goods and services. And we experienced the highest consumer price inflation in recent memory, pushing things like the cost of groceries and all other kinds of things that people need to survive. It pushed the prices of those things up. It wasn't just assets that inflated. Eventually, it was consumer goods too. And what's the end result of all of this? A world where the wealthy elite benefit from their portfolios going up, while average people suffer the impacts of their dollars not stretching as far as they once did, in tandem with ballooning shelter prices. Now, you can play devil's advocate and say, sure, the benefits provided help for people who needed it at the time, but what we haven't really seen people study or talk about is, was it worth the cost, both social and economic? The cost that was paid in the aftermath of all of this. I worry about the same dynamics here. Sure, these benefits might be easy to sell because, hey, we're giving people free money, but maybe they don't realize the knock-on effects that could happen a year afterwards. And there's evidence that the Bank of Canada has been preparing for returning to similar stimulative policies even as of a couple weeks ago. In this very undercovered speech from one of the Bank of Canada's deputy governors, he explains how the Bank of Canada will go back to normal business as usual balance sheet management. But personally, I'm not so convinced that it's as normal as they're claiming. Listen to this clip, and then afterwards I'll do my best to translate this banker speak.
We need to supply an amount of settlement balances or reserves that roughly matches that of the demand for them. And the demand is now estimated to be higher than where we thought it would be when I spoke about our QT process last year. Over the longer term, since the financial system will continue to evolve, you can expect that the demand for settlement balances will also evolve as well. Market participants can count on us to communicate our next steps clearly and ahead of time. And Canadians can count on us to manage our balance sheet in a way that both lets us achieve our monetary policy objectives and promote a stable and efficient financial system.
He explains that they will seek to provide the amount of settlement balances that are in demand by the big banks. If the big banks need more settlement balances, well, we, the Bank of Canada, will provide them. And as a quick recap, these settlement balances are the new money that is created and added to the system by central banks like the Bank of Canada, otherwise known as reserves. Usually in the US, they'll refer to them as reserves. In Canada, we talk about them as settlement balances. It's the accounts that the big banks have at the Bank of Canada that they can use for a number of different things, including overnight trading between each other. But the new money that's created are settlement balances in these accounts, and they're saying, well, we're going to let this amount float, providing the amount of settlement balances that we determine based on demand these big banks need. And throughout this speech, he reiterates time and time and time again that this is not QE. This is not quantitative easing, the money printing that you are familiar with from COVID. Don't worry, we're not doing QE. And that seems to be true. At the very least, that the name and the operation of the program may not be the same here, but I think that it could have a similar effect. By saying that you'll provide a floating amount of settlement balances, to me, this leaves the window open for massive swings in liquidity operations involving newly created dollars. Now, even if it goes by a different name, I'm personally skeptical that this strategy won't result in the similar side effects. So I'm concerned, but on one final note that's a little bit of a shift here on implementing this kind of policy again, to me, it seems like a political strategy that I've talked about time and time again, specifically on the Russ Matthews Show, which is the podcast-style series that I release right here on the channel. So if you haven't already, subscribe to the channel. It's free, doesn't cost you a dime. It only helps out the channel, doesn't sign you up for anything, so I'd appreciate you clicking that subscribe button. You'll have heard me talk about this idea or strategy that is that you should never let a good crisis go to waste. And that's what this smells like to me. The idea that when there's a threat looming, just as these tariffs are, politicians can make far more arguments about national unity and feel like they have the reason to push through policies quickly without thorough debate. And in this case, I think that this might be being used to keep the current political party in power longer, with an unelected prime minister who will be leading the charge shortly. And as of now, the NDP and the Bloc have claimed that they will vote to trigger an election as soon as possible. But this whole crisis and this new legislation that they're planning on passing, it really opens up the door for change here. Now, even though the NDP have promised that they're going to vote down the Liberals at the earliest chance, they now have the plausible deniability to say, hey, things have changed since we said that we'd trigger an election. Now it would be irresponsible of us to do that when we currently need to respond to these existential threats. And now that we need to work hard for Canadians to get these benefits passed through the House of Commons so that we can protect Canadian citizens. That's definitely a better argument. It sounds better to a lot of people. But to me, it still stinks of political maneuvering and never letting a good crisis go to waste. But who knows? I could be wrong and they could do the exact opposite. This is just the way that I see things going right now. But I'm curious, what do you think of all of this? What do you think of this rumored multi-billion-dollar program and the spending that goes along with it? Not to mention what that spending means for the economy and what that spending and effect on the economy means for the Bank of Canada's actions. All of these things are what are most interesting to me, and because they affect average people far more than anyone would like to have you believe. And that's what we talk about a lot on the channel. So subscribe to the channel if you haven't already done so. Again, doesn't cost you a dime, only helps out the channel. And let me know what you think and what I've missed on this video. Where am I totally off base? I'm trying to figure out this stuff just like you are. What have I gotten dead on? Let me know. I'm curious what you have to say. But with all that said, thanks so much for watching, everybody. I really hope this video helps you out at least a little bit, and I'll see you next time.